A significant slowdown in the CPI and Canadian inflation data suggested or gave hopes to the Canadian that perhaps Bank of Canada may not increase another rate hike in the month of July, which is supposed to happen on July 12th. But last week on Friday, Stats Canada published some preliminary number on the GDP, and that is showing us that the GDP is likely to grow by 0.4% in the month of May, which is not a good sign for Canadians hoping for a rate pause, because Bank of Canada will see this as an excuse that the economy is still resilient, it is still strong, the demand is still there, and they may have to crush it to lower the inflation down to, let's say, sub 3%. Ironically, if you look at the inflation data, the entire 100 basis point in the 3.4% inflation is coming from the mortgage rates. So since we have seen a significant increase in the mortgage rates, we are seeing an entire 1% in the CPI coming directly from the mortgage payment. So this is a self-inflicting wound that Bank of Canada is trying to scratch it, because they are the one driving this by directly increasing the interest rate, hoping that this will bring the CPI down to 2%. So if you take that out, your inflation data already sub 3%, close to like 2.5%. So that's pretty ironic. The other thing I want to share is the mortgage rates that will be staying higher for quite some time. One of the economists published an article on BN and Bloomberg saying we just have to retune our mind, our expectation in terms of having mortgage rates going back to the lower level, because the decade that we have since 2008 financial crisis, that decade is not coming back. That was the stimulus decade where every bank, every central bank was trying to stimulate the economy, but during that time the inflation was not going up, right? Now the inflation is too high and it is looking like remaining in that higher range. This doesn't justify lowering the rates in any shape or form. So we just have to retune our expectations, thinking that the rates may not go back to sub 3% anytime soon. So they may stay 4% and above. Right now it's already above 6%, and with another rate hike it may go to the higher 6, which means the qualification rate for new buyers is going to be somewhere close to higher 8, which is a significant amount of rate increase considering the amount of debt that people have or going to have in order to purchase real estate. So we still have to see the unemployment data. So the unemployment data, it is likely to stay low because we are importing a lot of people in this country. So even in Q1 this year, the net inflow of people coming into this country is around 290,000. This is the highest population growth in Q1 in Canada since 1970. So think about the amount of people we are importing. That is directly influencing the consumer spending, which is why we are seeing the GDP look so good, which is misleading, because if you look at the per capita basis, the living style, the lifestyle of people living in this country is deteriorating over time. So the GDP per capita has not moved since last 10 years. That has been stagnant, and I think one of the worst performing economy compared to G7 countries. So what's going to happen? I think the probability of having Bank of Canada raising interest rate one more time is much higher, and the lower unemployment data will also increase that percentage of probability even much higher, close to 100%, which means it will further slow down the real estate market, because I'm already seeing the slowness in the market in the last month. Yes, we saw an uptick in the market in the spring market season, but since Bank of Canada raised the interest rate on June 7, it has been slowing down very quickly, and this rate hike will further grind that movement completely, which will basically deter the buyers to go out and bid for real estate because the mortgage rate is still too high, and it looks like it's going to stay higher. So anyway, this is what I was imagining and thinking about how the market will move. But I think the buyers will stay on the sidelines for now because of the rate hike impact. And typically the buyers will start stopping their movement before the rate hike actually happens. And then of course there will be a shock effect after that as well. So we will see a very quiet summer, to be honest. and we won't see any movement picking up again before the fall market. But anyway, this is just me thinking and sharing my thoughts with you. Let me know what you think. Put your comments down below. If you like this video, give me a thumbs up, share, and subscribe, and I'll see you in my next week video. Thank you.